Dealer reacts to U.S. government dumping silver. Something is happening behind closed doors. A decision that few are watching, but one that could quietly reshape the wealth of an entire generation. For decades, silver sat quietly in vaults, overlooked, underestimated. But now, the government is moving it out. Not buying, not holding, dumping. And the question every serious investor should be asking is simple. Why now? What do they know that the public does not? By the end of this video, you will understand exactly what is unfolding and why the next 90 days may matter more than the last 90 years. Welcome back to Precious Metals Intelligence, the channel dedicated to decoding the strategic economic decisions that shape real wealth, long before the headlines catch up. If you are new here, this channel exists for one purpose: to help thoughtful, forward-thinking viewers like you separate genuine signals from market noise. For most people, silver is just a metal, something old, something their grandparents kept in a drawer. But for those who study economic strategy closely, silver has never been ordinary. It has always been a signal, a quiet indicator of what powerful institutions are thinking, long before they say it out loud. Right now, that signal is flashing. Reports and data circulating among analysts point to a noticeable shift. Government-held silver reserves, once treated as a stable strategic asset, are being reduced. Not hoarded, not expanded, reduced. And for anyone who understands how governments typically behave with reserve assets, this is not a small detail. It is the kind of decision that deserves real attention. To understand why this matters, it helps to step back for a moment. For more than 100 years, silver has played two very different roles at the same time. On one hand, it is an industrial metal. It goes into electronics, batteries, solar panels, and medical equipment. On the other hand, it is a monetary metal. Governments and central banks have historically held it alongside gold as a form of protection, a hedge against uncertain currencies, a backup plan when paper money loses trust. This dual identity is what makes silver different from most other commodities. It is not just something people use, it is something people trust. And trust, in economics, is never simple. So when a government decides to reduce its silver holdings, the natural question is, why now? Governments do not usually make large financial decisions casually. Every major move involving a strategic reserve asset tends to follow a reason, even if that reason is not always announced publicly. Sometimes the reason is liquidity. A government needs cash, and selling reserves is one way to get it quickly. Sometimes the reason is confidence. A government may believe silver's role is changing and no longer wants to hold as much of it. And sometimes the reason is timing. A government may believe prices are favorable right now and waiting could mean missing an opportunity. Whatever the specific reason turns out to be, the pattern itself is worth noticing. Because history has shown again and again that when large institutions move first, ordinary people usually find out last. This is not a story about panic. It is a story about pattern recognition. Consider how markets normally work. Prices are supposed to reflect information. When everyone has the same information at the same time, prices adjust smoothly. But that is rarely how the real world operates. Large institutions, including governments, often have access to broader economic data, deeper analysis, and longer planning horizons than the average investor. When they act, it is not usually random. It is calculated. And that is exactly why this current shift deserves a closer look. Silver is not simply being sold. It is being moved out of official hands and into private markets, right at a moment when industrial demand for the metal is climbing. Solar energy projects need it. Advanced electronics need it. Even certain defense technologies rely on it. In other words, the world is not losing interest in silver. If anything, global demand is quietly increasing. So the puzzle becomes clearer. Reserves are shrinking. Demand is growing, and the two forces are moving in opposite directions at the very same time. For a business professional or an aspiring investor watching from the outside, this is precisely the kind of moment that deserves attention, not because it guarantees a dramatic outcome, but because it represents a shift in behavior from an institution that rarely acts without calculation. This is where the analysis must slow down rather than speed up. It would be easy to jump straight to conclusions, to assume the worst, or to assume nothing at all, but careful thinking requires something different. It requires asking whether this current decision fits a larger historical pattern. It requires asking what happened the last time something similar occurred. And it requires asking honestly whether ordinary investors are seeing the full picture or only a small piece of it. That is where the story turns next. Because government behavior involving silver is not new. It has happened before in different decades, under different pressures and for different declared reasons. And each time it left behind clues. Clues that, when studied carefully, may help explain exactly what is unfolding right now. History rarely repeats itself in exact detail, but it often rhymes. And for those who study the relationship between governments and precious metals, this current moment feels strangely familiar. To understand why, it helps to look backward, not out of nostalgia, but out of necessity. Because government decisions involving silver have happened before, several times in fact. And in nearly every case, those decisions arrived quietly, well before the public understood their true significance. Take the mid-20th century, for example. During periods of currency stress, governments around the world adjusted their relationship with precious metals in ways that surprised ordinary citizens. Silver coinage was altered, reserve policies shifted. Metal that had once been treated as untouchable was suddenly released into circulation or sold into markets. At the time, most people saw these moves as routine administrative decisions. Looking back, analysts now recognize them as early signals of larger monetary pressure building beneath the surface. This pattern is not limited to one country or one era. Throughout modern economic history, whenever governments faced rising debt, inflation concerns, or currency instability, precious metals policy tended to shift first. Long before headlines announced a crisis, the quiet movement of gold and silver often told the real story. Why does this happen? The answer lies in how governments manage financial pressure. Unlike individuals, governments cannot simply cut expenses overnight or ask for a raise. When financial strain increases, options become limited. Adjusting reserves, whether by selling assets, restructuring debt, or changing monetary policy, becomes one of the few tools available. And because these reserves are often out of public view, changes can occur well before ordinary people notice any difference in their daily lives. This is precisely why historians and analysts pay close attention to reserve behavior. It is not because gold and silver movements are exciting on their own. It is because they often function as an early warning system, revealing pressure inside the financial system before that pressure becomes visible anywhere else. Now, apply this same lens to the present situation. A government reducing its silver reserves does not automatically mean a crisis is imminent. That would be an oversimplification, and careful analysis should always resist oversimplification. However, it does mean the situation deserves the same scrutiny that similar moments received in the past. If history has shown that reserve adjustments often precede larger financial announcements, then ignoring the current shift would be a mistake for anyone trying to understand where the broader economy may be heading. There's another important detail worth noting. In previous decades, when governments released silver into the market, the general public often had no framework for interpreting the move. Financial media moved slower. Information was harder to access. Ordinary citizens simply were not equipped to notice the pattern in real time. Today, that disadvantage has narrowed considerably. Data moves faster. Analysis reaches wider audiences. And for viewers who take the time to study these patterns, understanding a government's behavior with precious metals is no longer reserved for insiders or institutions. It is available to anyone willing to look closely. Still, one question remains unanswered. If history offers a clear pattern, why does the current moment feel different? Part of the answer lies in scale. The global economy today is far more interconnected than it was during previous precious metal shifts. Supply chains span continents. Industrial demand for silver now includes technologies that did not exist decades ago. A decision made by one government does not stay isolated. It ripples outward, influencing markets, industries, and investors far beyond its own borders. Another part of the answer lies in timing. Previous reserve adjustments often occurred during periods of visible economic stress, times when inflation, war, or currency collapse were already dominating headlines. This time, the shift is occurring quietly, without the same dramatic backdrop. That quietness is exactly what makes careful observers pay closer attention rather than less. When a pattern repeats without the usual warning signs accompanying it, it does not mean the pattern is less important. It may mean the opposite. It may mean the shift is happening earlier in the cycle, before the visible pressure becomes public knowledge. This raises the central question that carries the story forward. If reserves are shrinking while global industrial demand for silver continues to expand, what does that imbalance actually mean for supply, pricing, and long-term value? That question cannot be answered through history alone. It requires a closer look at the numbers themselves, the real forces of supply and demand shaping silver's future, and why that imbalance may matter more than most people currently realize. Numbers rarely lie, even when headlines do. And when it comes to silver, the numbers tell a story that many casual observers have not yet noticed. For decades, silver was seen mainly as a monetary metal, something people bought for coins, jewelry, or long-term savings. That perception is now outdated. Today, silver plays a critical role in industries that barely existed a generation ago. Solar panel manufacturers depend on it. Electric vehicle components require it. Medical devices use it for its unique antibacterial properties. Even advanced electronics, from smartphones to military-grade technology, rely on silver's unmatched ability to conduct electricity. This shift matters more than most people realize. Silver is no longer simply an investment choice. It has become an industrial necessity. And this is where the paradox begins. While global industries are consuming more silver than ever before, mine production has struggled to keep pace. Unlike gold, silver is rarely mined on its own. Most silver comes as a byproduct of mining other metals, such as copper, zinc, or lead. This means silver supply does not simply increase because prices rise. Producers cannot easily ramp up silver mining the way they might with other commodities. Supply is, in many ways, locked into decisions made for entirely different reasons. At the same time, demand continues to climb steadily. Renewable energy expansion alone has placed significant new pressure on available supply. Solar technology, in particular, has become one of the fastest-growing consumers of industrial silver anywhere in the world. As more countries invest in clean energy infrastructure, that demand shows no sign of slowing down. This creates a widening gap, a gap between how much silver the world produces and how much the world actually needs. For several years now, analysts have pointed to consecutive periods where global silver demand has outpaced global silver supply. In simpler terms, more silver is being used than is being mined. This kind of imbalance does not resolve itself quickly. It builds quietly, year after year, often without drawing much public attention until the pressure becomes impossible to ignore. Now place this industrial reality next to the earlier discussion of government reserves shrinking. On one side, global industries are consuming silver at a growing pace with no clear substitute able to fully replace its unique properties. On the other side, a major institutional holder is reducing its own silver reserves, adding more supply into private markets at the very moment the world seems to need more of it, not less. This is the paradox at the center of the story. Two powerful forces moving in opposite directions at the exact same time. Historically, when supply tightens while demand increases, prices eventually respond. This is not speculation. It is basic economic principle, one that has held true across nearly every major commodity throughout modern history. Scarcity, when paired with rising necessity, tends to create pressure that markets cannot ignore forever. Yet here is the deeper question worth sitting with. If industrial demand for silver is expanding and supply constraints are becoming more difficult to solve, why would any large institution choose this particular moment to release reserves into the market? There are a few possible explanations, and a careful analysis should consider each of them fairly, without jumping to conclusions. One possibility is short-term financial necessity. Governments sometimes require liquidity for reasons unrelated to long-term metal strategy, such as funding immediate obligations or managing broader fiscal pressure. Another possibility is a difference in time horizon. What appears short-sighted from an investor's perspective may reflect entirely different priorities from a government's perspective, particularly when facing near-term financial demands rather than long-term asset appreciation. A third possibility, and perhaps the most important one to consider, is market timing. If current prices are viewed as favorable relative to other financial needs, releasing reserves now may simply reflect an institutional judgment about value, regardless of what industrial demand trends suggest for the future. Each of these explanations is plausible. None of them can be confirmed with total certainty from the outside, but together they point toward a larger truth that deserves serious consideration. By this point, the pattern is clear. Reserves are shrinking, industrial demand is climbing, and history suggests that such imbalances rarely stay hidden for long. But one question still remains unanswered, and it may be the most important question of all. What is the actual intent behind this decision? Understanding institutional behavior requires more than observing what an institution does. It requires asking why it does it, even when the full answer is not publicly available. This is where careful analysis becomes essential, because jumping to conclusions can be just as misleading as ignoring the pattern altogether. There are several possible explanations, and each deserves fair consideration. The first explanation involves liquidity. Governments, like any large financial entity, sometimes need immediate access to cash. Reducing a reserve asset, even when considered strategically important, can serve as a practical solution when short-term obligations outweigh long-term holding strategy. In this scenario, the decision may have little to do with silver itself, and much more to do with broader fiscal pressure occurring elsewhere in the economy. The second explanation involves debt management. Many governments today face rising debt levels and increasing costs tied to servicing that debt. When traditional revenue sources are not enough, institutions often turn to existing assets. Selling reserves, including precious metals, becomes one of several tools available to help offset these growing financial obligations. If this explanation applies, the silver decision may be less about silver specifically and more about a wider financial strategy playing out behind the scenes. The third explanation involves market signaling. Whether intentional or not, large institutional moves send signals to other participants in the market. When a government sells a significant asset, it can shape perception, influence investor behavior, and even affect how other institutions plan their own strategies. Some analysts argue that certain reserve decisions are made with this influence in mind, not simply for financial necessity, but to help guide broader market expectations. None of these explanations can be confirmed with complete certainty from the outside. Governments rarely explain these decisions in full detail, and much of the reasoning remains behind closed doors. This is precisely why careful, historically grounded analysis matters. Rather than assuming a single motive, a responsible observer considers multiple possibilities and remains open to how the situation continues to unfold. What professional investors and institutions tend to do in moments like this is instructive. Rather than reacting emotionally, experienced market participants usually pause and study the broader pattern first. They ask whether current behavior aligns with historical precedent. They examine supply and demand fundamentals. They consider multiple explanations rather than settling on the first one that feels convincing. This measured approach is often what separates long-term financial resilience from short-term reactionary decisions. For business professionals and aspiring entrepreneurs watching this unfold, the lesson is not necessarily about silver alone. It is about recognizing how institutional decisions, especially quiet ones, often carry more weight than they initially appear to. Strategic decisions rarely announce themselves loudly. They tend to reveal themselves gradually through patterns, data, and historical comparison, long before mainstream attention catches up. This brings the analysis to its most important turning point. If reserves continue shrinking while industrial demand continues rising, and if history suggests that similar imbalances have preceded larger financial shifts in the past, then the central question is no longer simply about government intent. It becomes a question about consequence. What happens next if this pattern continues along its current path? And more importantly, what should a thoughtful, wealth-conscious individual take away from recognizing this pattern early rather than after it becomes common knowledge? That question cannot be answered through speculation alone. It requires stepping back one final time, drawing together the historical precedent, the industrial imbalance, and the institutional motivations already discussed into a single, clear conclusion.